We all know what savings are. It's the excess of income over expenditure. Basically, whatever we don't spend becomes our savings. Naturally, when we start our careers, our expenditure is often more than our income. This is when we borrow or take loans to fill that gap. But gradually, this cycle reverses. As we grow in our careers, the possibility to save presents itself. It's a source of comfort to us that we have this pool of money to fall back on. But are you sure that the value of your savings today can bail you out on a rainy day? It is said that India is a country of savers. But India is also a country where inflation is running at about 8%, which means that every year your savings are losing their value by that much. Prudent investing can offer a way out over here. Often the terms saving and investing are used interchangeably, but they are in fact not the same. Saving is whatever you manage not to spend, but investing means committing your money with an expectation that you will receive a higher amount in the future. Of course, this can never be guaranteed. There are many instruments in which even your principal amount can be at risk, but more on that in just a bit. For now, let's understand what investing really means. Another feature of investing is that it is more longer term in nature, or should I say, it should be more longer term in nature. Your retirement kitty, children's education, buying a house, and so on are some examples of longer term goals which can be fulfilled via the investing route. Of course, you can save for shorter term goals also, but you have to choose the right instruments. So, we can say that every investor is a saver, but not the other way around. So, where can investors invest? There are two broad options. The first is financial assets, and the other is physical assets. Now, what are financial assets? They refer to mutual funds, shares, bonds, bank deposits, PPF, and so on. While physical assets are everything that you can touch and feel for yourself, like real estate, a residential accommodation, a shop, or even precious metals like gold, silver, diamonds, etc. Now, most of us are familiar with physical assets. It is said that Indians hold one of the largest private reserves of gold in the world. And who is not familiar with our love for our own home? But let's take a moment also to think about what financial assets can offer us. Let's start with liquidity. If you're in need of say 20 or 30,000 rupees, will you sell off your jewelry worth much more to pay for it? Or let's say even if you need 2-3 lakhs, will you sell off an entire house just because you need a small portion of money? But what you can do with financial assets is sell them in parts, just the amount that you need, should you need it. Which is why we say you have greater liquidity. You don't have to sell a whole big asset just because you're in need of a part of it. Next is flexibility and convenience. You can invest in financial assets at your ease, day or night. You don't have to wait just for business hours. You don't have to keep taking half days from office just for paperwork or for shopping. You can do it sitting in your home, and the records are pretty easy to maintain as well. There is greater transparency. You know what you're getting into, and there are regulators watching your back. But remember in the beginning I said that prudent investing can be a way out and also that returns are not guaranteed? So let's talk about the concept of risk. Anybody investing should know about the risks before they get started. So in the second episode of this podcast, I'll talk about the risks in greater detail, the different types and how to mitigate them. But for now, I'll just keep it simple. How many of you have given a hand loan to a friend or a relative and not gotten it back? So the possibility of not getting your money back was the risk that you took in lending that money. Likewise, if you invest in a financial institution as well, there is a risk that the money you earn from that investment or even your principal may be at risk. Different assets have different risk levels. For example, equity will have much more risk than debt, which in turn will have much more risk than a bank FD. Even within equity, day trading may be considered riskier than holding direct stocks, which in turn could be considered riskier than investing in a professionally managed mutual fund. So we can say that risk is relative to the product and to our own risk appetite. Some people are willing to take more risks compared to others. So you must think about what kind of investor you are, and therefore what is the level of risk you are willing to take before you think about where to invest. Start small if you must, but do start. The earlier you start your investing journey, the more wealth you'll be able to create. You work hard to earn your money. Don't you think it's about time your money works hard for you too? Thanks for listening and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.